Hi there, this is Alvin from Dr. Wealth. DBS recently published a report talking about two targets in particular. One is a STI target, and the other one is a currency target. Okay, I would say it's target projections. And that got a lot of interest. Media published it, and the reaction was quite, I guess, surprised by the figures, and some may even think that's audacious. Okay, so I want to also give my point of view on some of these projections and see whether how realistic they are. So the very first projection is on the Straits Times Index, which is our Singapore stock index, and currently it's about 4,400 ish. And DBS was saying that by 2040 it will hit 10,000 points. So that's more than double from where it is. And some they think that wow, 10,000 is like so far away and it's not really realistic, and 5-digit kind of milestone and barrier, not easy to achieve, right? So that was the general sensing that I get from investors, okay, at least on their online commentaries and their viewpoints. But that is why we need to annualize it to really look at the figures and see whether it is along with the long-term rate of return for STI. Then we can have a benchmark, right? Because if it's like 10,000, 20,000, it doesn't give us a yardstick that we can really see whether it's realistic or not. So to me, it's not audacious after we look at the annual returns. Okay, and in fact, I would think that it would be a bit disappointing if we hit only 10,000 points by 2040. Okay, how do I arrive at that conclusion? So I did a CAGR calculation, right? So based on what we are right now, 4,440.21, that's index level at the time of recording. And the future value is 10,000 points, and we are 15 years away from 2040. So that would end up with about 5.56% annual return for the STI in the next 15 years. This is not very fantastic if you ask me, right? Because considering that equity return should be higher, maybe 7% or more, to consider market norms, right? Long-term market norms. So actually 5.56, and considering that many stocks in the STI are giving like 4-5% dividend yield, that means the capital gain is only like 1-2% at most. That is not impressive at all. Right? So I would say that it is not audacious. In fact, if it only hit 10,000 points by 2040, I would be disappointed with the overall returns. And of course, DBS also did some scenario, right? If let's say they hit that 10,000 points, indeed it's around 5-ish% per year. And it could be even lower if it doesn't hit that 10,000 points by 2040. It will be like below 4% return. And I guess because they were using the past 15 years of annualized return in STI, which is just 2.7%, right? It is not low, it is not high. And that's also because in their report, they also mentioned that there was like a 17 years of stagnancy, okay, since especially 2007 or 2008, that region, right, just before the great financial crisis. STI has not really surpassed that for a long time until this year. So that is why I guess the probably the projection wasn't that aggressive, right? So if you ask me what would be a nice number, I would think that hit 10,000 by 2036 earlier, okay, in 11 years time. Of course, you can do it in 10 years, that would even be better. So that would reach around 7.66% per year for the next 11 years. Okay, so is this realistic? And let's look at the STI ETF returns, right? Because we can't invest in the index, but we can look at the ETF if you are interested in investing. So the fund has delivered about 7.53% since its inception from 2002. Okay, remember the lost years were between 2007 and 2025, right? So 2002 would consider the bull run between 2002 to 2007. Okay, so that's why the returns is higher than the past, say, 15 years or so, right? Because it captured the previous bull run. So if we are at the cusp of another bull run, then I would think that hitting this 7+% or even higher shouldn't be too difficult, right? Unless, Singapore really this time around isn't a bull run either, and it's going to stagnate for another 10-15 years, then that's totally a different story. Okay, but I don't think so, right? And also the DBS report was quite positive regarding the fund flows, the EQDP and things like that. So there are reasons to be positive about the STI, right? So that is my viewpoint, right? I do think that Singapore stock market deserve higher levels for the STI at least, okay? But that's my wish lah. Okay, whether they realize or not is also a different story. And the next projection that DBS was predicting was that the US dollar and Sing dollar will become parity. What does that mean? That means one Sing dollar equal one US dollar. Okay. So again, some will think that wow, this is not possible. A lot of bad things will happen, so on and so forth. Nothing is impossible, right? So my view is that it is possible, but compared to the STI argument, I think this would be a bit more stretch. Okay, why would I say so? Right. So first thing, let's take a look at the historical performance of US dollar against Sing dollar. Indeed, it's true. If you look at the last 20 over years, the US dollar has depreciated against the Sing dollar. Okay. At one point, it was 160, 170 plus for a long time, right? And then even we compare the last 15 years, okay, since 2010, that point in time was around 1.4. Today, it's about closer to 1.3. And if you look at the chart, the US dollar and Sing dollar has fluctuated within a range for the last 10 years between like 1.3 to 1.5, right? That kind of range. And could it be lower, right? In the next 15 years, definitely possible. Okay, the last 15 years, the depreciation is rather gradual, I would say, minus 0.5% per annum. It is not that again aggressively weak, and this is what DBS have projected, right? Because they use particular events to show that there were quick depreciation of US dollar against Sing after certain events happen. Okay, like the Plaza Accord between 1985 to 1995, US dollar against Sing has depreciated by 40%. Right, last time when I was much younger, okay, I wouldn't have known how to read forex pairs, but US dollar used to be like one US dollar to more than two Sing dollar. Okay, so a lot has changed, right? So over the decades, indeed, the Sing dollar has appreciated against the US dollar. And then when China joined the WTO and the Great Financial Crisis, right? So the US dollar depreciated, the depreciation accelerated to 35% drop, right, within that window. So they think that another round is probably coming, right? Another 30% decline from the peak of 1.45 exchange rate would have reached parity. Okay, so they think that it is possible, and there were four drivers of this move, right? So one is a weaker US dollar. The interest rates are coming down, and usually that also spells a lower US dollar. And second is productivity-led growth in Singapore, right? So even we have an aging population with AI, with all this adoption, productivity may increase, and our economy may attract more demand for our Sing dollars. Third, safe haven inflows. Our finance industry is very strong and indeed projected to go even stronger. Foreign wealthy individuals or even family office may set up more investments here, and that would demand for higher Sing dollars again. And fourth, current account surplus. And this is always a hallmark of our Singapore governance, right? We have a lot of money, and that again gives Sing dollar like a safe place to be in. Okay, again, that may increase the demand for Sing dollar. So all these reasons may help strengthen the Sing dollar. And if we take a look at their projection, right, if the parity is really reached in 2040, the annual depreciation of US dollar against Sing will be around 1.73%. Okay, again, a bit more stretch compared to what we saw previously in the last 15 years was about minus 0.5, right? But it was a relatively calm period. So not impossible, again, right? The reason why a lot of currency weakens against the Sing dollar is because our central bank policy managing a Sing dollar strength against a basket of currency via this Sing dollar NEER. I always pronounce it as SNEER. It's not a very good word, but yeah. Okay. So it goes up over the long run, right? In the past 20 over years, you can see that the red line in the chart, which is SNEER line, and it's gradually appreciating. Okay, so against a lot of other currency, it would appreciate. We just don't know exactly what currency, but definitely US dollar, yen will be inside, renminbi probably will be inside, euro will be inside, right? So the major trading partners currency would be inside. And why we want appreciation in the Sing dollar is because a lot of things are imported in Singapore, and this is one of the ways to manage inflation in Singapore. Is when your Sing dollar is strong, that means your import will cost less, right? And that help manages the price for Singaporeans. Okay, so that is why, indeed, true over the long run, Sing dollar would appreciate. Okay, and we have the reserve to strengthen the Sing dollar if we need to. So that makes that bull case for Sing dollar. And these are just some examples, right? You can see Aussie dollar used to trade above Sing dollar in terms of strength, and now is the other way around, right? So last time, one Aussie dollar would need more than one Sing dollar to convert, but today is the other way around, right? 85 cents of a Sing dollar, 85 cents Sing would be required to just convert to a Aussie dollar. Okay, so the tables have flipped. Same thing against other currency like euro. Okay, euro has also depreciated against Sing. Last time used to trade above $2 per euro. Now is 1.5, right? And the trend of decline is quite steady. And also pound sterling. When I was very young, I remember pound was like the most impressive one. One pound you need like more than $6 Sing. Okay, so roughly you know how old I am. And then now the pound sterling is just 1.7 Sing dollar. Okay, so that also shows you it's not just against the US dollar, but across the board. Most of the currency will depreciate against the Sing dollar because of the way that our central bank manage the currency. There were other projections that were done by the DBS research team, the economic team, I think, and just that it wasn't the main spotlight, right? I think STI at 10,000 and the US dollar Sing dollar parity stole the thunder. But that doesn't mean that there are other things that are not important. Okay, I do think that property is also a very important part of our Singaporeans' wealth. Majority of the assets are in property. So DBS expect about 2 to 3%, okay, growth per year to 2040. I would say this is realistic, right? Slightly conservative, because if you take a look at the private non-landed prices in the last 30 years, okay, the price have gone up around 4% per year, right? So 2 to 3% is definitely realistic, and pricing in a bit of a slowdown in terms of the appreciation. Okay, of course, we won't know exactly how the future will unfold, but overall, the expectation that Singapore property will continue to appreciate is likely, right? Just the exact number is an unknown. Okay. And lastly, there's also a report on where are the growth area in Singapore sectors, right? So DBS identified 7 of them: digital infrastructure, cloud AI, advanced manufacturing and semiconductors, biotechnology and personalized medicine, cybersecurity, green energy and sustainability tech, digital healthcare and wellness, mental wellness, autonomous vehicles and urban mobility. Okay, so these are the 7 sectors where the DBS team believe that they would have the growth that help power our Singapore economy higher. Okay, so I was also thinking out loud, right? What are some of the listed companies that could be in some of these sectors? Okay, so this is just for reference, right? This is not from the DBS report. This is just my personal value add. Okay, trying to link what the sectors, the growth sectors are to the listed companies. So in digital infra, cloud, and AI, I would think that Capital DC and Singtel would be a major influence. Why? Because both have a lot of data centers in Singapore. Okay, so if you want that digital infrastructure, the cloud, the servers, then these two would definitely benefit from that tailwind. Second, advanced manufacturing and semiconductors, AEM, UMS, Franken, these are plugged into the semiconductor value chain, right? So EM serves Intel, UMS serves Applied Materials, and Franken serves ASML. Third, biotech and personalized medicine. This is harder to find, right? Most of the biotech are foreign companies, whether is it the American ones or the Chinese ones or even the European ones. And they have set up factories here in Singapore to produce. some may even have R&D here, right? So I think DBS report was more pertaining to that aspect of biotech and medicine. It's more about foreign companies. But locally, there's this Merxus. It's very hard to pronounce it. Okay, it recently listed in Hong Kong, right? So, but it's based here. Okay, so it's considered a Singapore company listed in Hong Kong. So that could be a biotech play. Cybersecurity would have StarHub, because StarHub has a joint venture with Temasek and owns half of Ensign Info Security. Singtel has Trustwave and NCS. ST Engineering has Decrypt, and a lesser known Multicam, a small cap, has a MTech, which is a cybersecurity distributor and turnkey solution provider in Asia. Right, so these companies would also be involved in cyber. And for fifth will be green energy and sustainability tech. Then this will be obviously Semicon Industry and Capital Corp, right? They are very into clean energy, renewable energy, and the growth of it, they would definitely be part of it. Digital healthcare and mental wellness, I'm thinking in terms of telemedicine, right? So you will have like Raffles Medical, which has the Raffles Connect, and Thomson Medical will have the White Coat. These are telemedicine platforms. And lastly, autonomous vehicles and urban mobility. We don't really have very big companies that are doing autonomous driving, but there will be companies that are going to benefit, right? If there are more autonomous vehicles, these companies can actually save more costs, because nowadays, providing mobility service, right? Providing your ride hailing, the driver needs to be paid a decent amount in order for them to drive, right? And that is usually a major cost to the platforms as well. So ComfortDelGro and Grab would definitely benefit if there are more autonomous vehicle adoption in Singapore, right? So their profit margins should also increase. Okay, so that's also part of productivity. Then the drivers can definitely do something else, right, in other industry and add value to the economy in a much bigger way. So these are the ideas. This is just for you to think about, right? They are not recommendation to buy or sell. Okay, right? So I hope you have a better understanding and what is realistic, what is more stretched in terms of some of the projections. But it's a good exercise, right? And I hope that this will give you some ideas as well, right? How to manage your investment going forward. Thanks for watching. Give me a thumbs up and subscribe to the channel, and I'll see you in the next one. Goodbye.